Good Monday. This is Jay Brew, co-chairman of Sea Freedom Brew. Well, we have the glass up on the screen. And the question in here, especially after numbers we got last week, is the glass half full or is it half empty as we look at this economy? So what we talked about in last week's webcast is that the 3-month coincident index that we finally got after the problems with the government shutdown showed 0.7% growth. Interestingly enough, we look over the last year and it averaged a 0.7% growth. So when we think of that and look at that was one of the factors that we said that we felt that the Fed would not start tapering in here. Well, we got some figures that looked pretty good last week. For instance, we got GDP coming out with 3.6% growth, which sounds a lot healthier than the 2.5% growth we had in the second quarter and the lower growth yet in the first quarter. Yet one of the pieces is this investment piece. Inventories contributed 1.76% of total GDP, which is huge. So when we look at the consumer in here, 1.24% going down to 0.96%. Once again, slower growth on that vital consumer piece. Inventories up, consumer down. So when we look at that story and we match it up with that 3-month coincident index, once again, are those inventories going to sell in here? And then the question is, did the buildup in those inventories, especially as we saw the ISM index rise, also lead to unemployment declining? Once again, unemployment going down in here to 7%. Good news falling into the Fed's projections of where they want that overall unemployment number. Yet we think of it from the standpoint, is the glass half empty or is it half full? Even though it was good news on U6, coming from 13.8% down to 13.2%, still over 13%, must give the Fed pause in here. So when we look at it from the standpoint of unemployed 27 weeks and over, still staying below 4 million. In fact, that number stayed pretty much the same, just a touch over 4 million in this past period. Once again, the situation giving the Fed pause in here. But what we keep talking about that I think is one of the most important numbers in here is the participation rate, the labor force participation rate. When we look at it from the standpoint of where we've been in terms of participation, the 70s, the 80s, is that this number, even though there was some good news that it headed up a little bit this past time, you still look at it from the standpoint of going back into the 70s when participation was at that level before. So when we think about that and we think about where the Fed is going, we got released the 6-month leading index. The 6-month leading index coming out here at 1.4% across the country. So we look out over the next 6 months. Once again, there's some states that have negative growth. There's most of the states in that dark to light green. But we have South Carolina showing actually greater than 4.5% growth. But on average, looking across the country, 1.4% growth. When we look at it from the standpoint of the average for this year, 1.5% growth. So it just continues at the same growth rates that once again we based our feelings before that the Fed would not taper. That this is an economy that's really operating at a very low level. And the thing is that if the Fed starts to taper, would it have the impact of slowing down the economy more, causing that participation rate to stay at these historically low type levels. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.